Okay, yet again, I'm back, your host in today's video presentation. Lwando Franklin is my name, the lead tutor, the Chief Executive Officer, and the pioneer of FCO Accountants Tuition Center. Before I get started with today's topic, which is the WACC, weighted average cost of capital, I just want to encourage all our viewers to make sure that you raise questions relating to WACC in the chat box. I also encourage you to make comments about the quality of this video in the comment section of this video. All the questions raised will be attended to depending on the availability of time, and the comments raised will be used to improve our lecture delivery. For the new viewers, ensure you subscribe and like the video and share the video. So I'm going to explain the following terms: the meaning of WACC, the steps to be taken when calculating WACC. Number one, there we have the WACC. WACC is the weighted average cost of capital, which is the average return expected by the investors. It is calculated when a project is being funded by different types of capital. And that capital should be used to evaluate the project. WACC can only be used under the following conditions or assumptions. Number one, the new project to be undertaken has the same risk profile as the existing operations of the business, meaning you are going into the same type of business. You're undertaking another project with the risk profile as those of the existing operations. If the risks are different, you cannot use WACC. Number two, the capital structure required. The capital required for the new project should not change the existing capital structure. If it is going to change the existing capital structure, then WACC should not be used. Number three, the amount of capital required or the size of the project should be in relation to the size of the business. That simply means the new project should require incremental capital. So there are three conditions or assumptions under which WACC operates. Then now we go to the steps that you need to take when calculating WACC. Number one step is to calculate the cost of the capital for each type of capital. Number two, calculate the market values of the types of capital involved. Number three, calculate the weightings, or rather the proportions. Number four, calculate the WACC. And the WACC, the easiest or simplest method, WACC is equal to cost of equity multiplied by the proportion plus cost of debt, one minus T multiplied by the proportion. That is how work is calculated using this method. K is the cost of equity, P is the proportional weighting, and then KD is the cost of debt. 1 minus T, T is the tax component, multiplied by P, which is the proportion. So I'm going to explain how do you calculate the cost of equity. Cost of equity, there are two methods available. Cost of equity, we have one, CAPM. CAPM simply means the capital asset pricing model. Capital asset pricing model. Number two, we have dividend valuation model or dividend growth model. So the method to use will depend on the information given. CAPM, when you are using CAPM, is cost of equity is equal to risk-free, that is interest from risk-free, such as treasury bills, plus beta factor, return from a market as a whole, less risk-free. So the method that you use will depend on the information that is given. Dividend valuation model, we have cost of equity is equal to DO, 1 plus annual growth in dividend divided by market price per share, excluding dividend, plus annual dividend growth. So these are the two formulae that you can use when calculating the cost of equity. For debt, also we have two approaches depending on the nature of the debt. We have redeemable. Redeemable debt. The cost of debt for redeemable debt is the internal rate of return. Irredeemable, irredeemable debt, the cost of irredeemable debt is by formula, which is interest, 1 minus T, divided by P, or multiplied by 100. So under this formula, we have interest. The interest is based on the par value of the debt, and normally that is 100. So interest to be based on the $100, which is the par value of the debt. Then we have the T. T is the tax component, which is expressed as a decimal point. P is the market value, excluding interest, at par value. So these are the methods that can be used to determine the cost of a capital. So now we can look at this question together. We have the finance director of a company has heard that the market value of the company will increase if the weighted average cost of capital of the company is decreased. The company which is listed on the stock exchange has 100 million shares. It's very important. 100 million shares in issue, and the current ex-dividend ordinary share price is $2.5 per share. A company also has in issue bonds with a book value of $60 million. Their current ex-interest market price is 10 per 100 bond. The current after-tax cost of the debt, this is after tax, is 7%. And the tax rate is 30%. The recent dividend per share of the company are as follows. So this is dividend growth method that we're going to use. So we need to establish the growth. The growth in dividend is calculated using historical method. Current dividends paid divide by earliest dividends minus 1. So that is how you determine the growth. So the earliest here is 21.8 divided by the earliest 19.38 minus 1. The number of years here, there are 5, but in the first year, there's no growth. So you use the number of years less 1, which will be 4. And the growth there to the nearest is 3%. Now we can calculate the cost of equity. We have the formula. Plus G. So the dividends to be paid is 21.8 multiplied by the growth, 1 plus 3%. The market price per share, since the dividends are in cents, you should also change the 2.5 into cents to be 250 plus the growth of 3%. This will give us 12%. 12% is the cost of equity. That is, we are attending to that question. Calculate the market value after tax weighted average cost of capital following circumstance A or 1 before the new issue of bonds takes place. So now, under the old bond, we already know the cost of the debt, which is after tax. So we don't need to calculate it. After we are done with that, we need now to do the market values. The market values, we can use this part. Market values will be Market values will be market value of equity. There are 100 million shares. Multiply by the cost is 2.5. This will be 250. Then market value of debt. We have the book value, 60 million. For every 100, the cost is 104. We are given the cost of 104 for every, which is indicated there. We have the amount given on the debt. It is the financial director. Okay. So the price is here. The market price of 104 per 100, and that's the amount here. So we get 62.4. The total is 312.4. The proportion of 250 upon the total is 80%. And the proportion of the debt over the total is 20%. This should come back to 100. We have found the market values and the proportions, or the weightings rather. We can now calculate the work. The work here will be cost of equity multiplied by proportion plus cost of debt, 1 minus t, multiplied by the proportion. The cost of equity, we calculated 12%. The proportion here is 0.8, that is 80%, plus the cost of debt is already 7%, and it's after tax, so you ignore the t. 7 multiplied by 0.2. Therefore, the work here, total is 11%. So before the issue of a new debt, the work, the weighted average cost of capital is 11%. Now, if we take into account after the new issue of bonds takes place, so we are told the financial director proposes to decrease the weighted average cost of capital of a company and hence increase its market value by issuing the 40 million of bonds at their nominal value of 100 per bond. These bonds would pay annual interest of 8%, 8% before tax, and would be redeemed at a 5% premium to the nominal value. So redeeming at a premium, it would mean 5% of 100, which will be 5. So to be redeemed at once, $105. Redeeming at a discount you remove, would have removed 5%. So now we need to find out what is the new market values of the securities once there is the new shares. So now the new market values, the market value of equity will remain the same. Market value of equity will remain the same. It will be 250. The market value of debt one, it was the 2.4. Market value of debt 2, the market value is given as 40. So total here, it will be 342. 352.4. That is the new. And what will be the proportion now? The proportion will be there, 250 as a percentage of 352.4. It will give us 0.7. There it will give us 0.18. There it will give us 0.12. And this will give us 1. So now this new debt will be redeemable in 10 years. So the cost of debt that is redeemable is the internal rate of return, which we should be able to determine. First, we need to know the cash flows. The cash flows here will be 8 multiplied by 100 less the tax component you remain with. So the cash flows will be interest of 5.6. Now we can start at the cost of the interest which is 8% less tax component, that will be 5.6 again. So we can start at 6%, you want to round off. So we have here cash flows, discount factor, present value. Then we can also try at another discount factor, which we are going to determine, then their present value. So here we are starting at 6%. In year 0, there was 100. Year 0 discount factor is 1, which will be the same there. Year 0, the discount factor is 1. From year 1 to 10, there will be cash flows of 5 point. Annuity at that, the annuity will be 7.36. And the total there will be 41.22. In year 10, the redemption, including the premium, it will be 105. Discount factor in year 10, that is present, 0.558, multiply by that, 58.59. NPV, 0.19 negative. So if it is negative at 6%, for it to be positive, we can try 5%. Because internal rate of return is trial and error, so we try 5%. There, the annuity is 7.722. Multiply by 5.6, it will give us 43.24. In a single year, year 10, it will be 0.614. Multiply by that, it will be 64.47. It will be positive 7.71. The internal rate of return, you can calculate it using the formula. Lower rate plus NPV at lower rate divide by NPV at lower rate plus NPV at a higher rate. A higher rate minus lower rate. So we can put the figures there. We have, can use this part. The lower rate there is 5%. Plus NPV at the lower rate is 7.71. Divide by NPV at the lower rate is 7.71 plus NPV at the higher rate, 0.19. Higher rate is 6%, lower rate is 5%. Approximately there, the cost of capital is 6. So that is the cost of capital using the internal rate of return formula. Now we can calculate the work. The work there is equal to cost of capital. We had calculated 12%. Proportion there now it will be 0.7 plus cost of debt there is 7%. We had calculated proportion of 18 plus cost of a new debt 6% multiplied by the proportion 12. So this gives us 10.4%. Now, comment on your findings. When debt is increased, that proportion of debt, because debt is cheaper than equity because the interest on debt is allowable. So it will reduce the cost of capital. The cost of capital that we calculated without the new debt was 11%. The cost of work with a new debt has gone down from 11% to 10.4%. This confirms that debt is a cheaper cost of capital than equity. And when you reduce debt up to a certain level, which we call the optimum capital structure, it will reduce the work. And when work is reduced, the value of the company will increase. So for today, we can end here. On behalf of FCO Accountants Tuition Center, I just want to say thank you for supporting us. May the Almighty God, Jehovah, bless you beyond measure.